Welcome to The Explainer. Today, we're unpacking what is widely known as the second pillar of business strategy, dividend policy. We all get that businesses exist to generate value, but the massive million-dollar question every successful company eventually has to answer is, well, what do you actually do with that value once it's created? Do you hoard it? Do you hand it out? It's a far more complex puzzle than it might appear on the surface. So let's figure this out together.
Picture this. I want you to imagine yourself as a CEO for a second. You've just had an incredibly profitable quarter. Your bank accounts are literally overflowing and, hey, congratulations. But now you face a fundamental and honestly incredibly stressful dilemma. You've got investors breathing down your neck, eager for their cut of the profits, but at the exact same time, you have competitors trying to steal your market share, economic downturns looming on the horizon, and shiny new products that desperately need funding. When it comes to the shareholders' reward, do you hand that cash out right now, or do you lock it down and retain it to fuel your company's future growth?
Okay, let's dive into this. This dilemma creates a massive corporate tug-of-war that executives face every single quarter. On one side, we have payouts. This is the shareholders' reward, literally handing cash directly back to the people who funded you, whether that's through quarterly dividend checks or share buybacks. It gives them instant gratification and a very tangible return on their investment. But on the exact opposite side, we have retention. This means keeping that cash securely inside the company to expand into new markets, innovate your product line, build new factories, and drive future compounding growth. It's an incredibly delicate balancing act between satisfying today's desires and securing tomorrow's dominance.
Section 1. The Great Academic Debate. Irrelevance versus relevance.
Side 1. The Purists.
For decades, the absolute brightest minds in finance have fiercely argued over whether this payout versus retention decision actually matters at all. Let's start with the theorists who firmly plant their flag in the irrelevance camp. This side is led by the famous economic duo Modigliani and Miller. They argue that under perfect market conditions, a firm's dividend decisions do not affect its overall value whatsoever. Let's break down the mechanics of why they believe this, because it's pretty interesting. Imagine a company has a stock price of exactly $10. If they decide to pay out a $1 dividend to their shareholders, the theoretical value of that stock immediately drops to $9, right? The investor now has a $9 share and a crisp $1 bill in their pocket. Their total wealth is still exactly $10. Modigliani and Miller argue that in a flawless market environment, it makes zero difference if you hand out the cash today or keep it to grow. The intrinsic worth of the company and the wealth of the shareholder remain exactly the same.
But I really want you to stop and ask yourself, does it actually not matter? Think about your own portfolio for a second. Have you ever encountered a truly perfect market? What about the taxes you have to pay on those dividend checks? What about the transaction fees every single time you buy or sell a stock? And, maybe most importantly, what about the simple fact that human beings are highly irrational? Perfect markets are a wonderful thought experiment, but reality is, well, a whole lot messier. So let's pivot sharply from that purist view and challenge it by bringing in the opposing heavyweights.
Section 2. Side 2. The Pragmatists.
Opposing the purists, we have the pragmatists. This camp is championed by theorists Walter and Gordon, who firmly insist that, yes, dividend decisions absolutely do matter. To understand firm value in the real world, you have to link dividend decisions directly to two crucial metrics, return on investment and the cost of capital. Let's define those simply. Cost of capital is basically the hurdle rate. It's what a company costs to acquire money, or the absolute minimum return they must clear to make an investment worthwhile. Return on investment, on the other hand, is what they actually earn when they put that money to work. And this brilliantly illustrates Walter's model of balance, which acts like a mathematical seesaw to guide executives. If the company's returns on investment exceed their cost of capital, it means they are highly efficient at making money. In that scenario, retention is clearly the better strategy. They're a profit engine, so let them keep the cash and compound it. But if their returns actually lag behind that cost hurdle, a payout is better. The company isn't using the cash effectively, so just give it back to the shareholders so they can invest it elsewhere. And if returns perfectly match the cost, you have total neutrality.
Section 3. The Psychological Twist, Gordon's Extension. Now, let's move away from pure math for a minute and get into the human element. Because at the end of the day, markets are made up of human beings, and human psychology plays a massive role in how we value a business. Enter Gordon's famous extension of the relevance theory. I want you to put yourself in the shoes of an investor right now and think about this classic concept, the bird in hand. When you're looking at a company's profits, what gives you more peace of mind? A promise of future wealth generated by hypothetical corporate growth, or cold, hard cash deposited directly into your pocket today?
So the crucial point is Gordon stresses the powerful psychological preference investors have for near-certain dividends over uncertain capital gains. As investors, we are naturally risk-averse. We strongly prefer guaranteed cash. We value that near-certain bird in the hand much more than the risky, uncertain promise of capital gains out in the bush. Future growth is always hypothetical. Markets crash, new competitors emerge overnight, global economies slow down. The promise that a company will be worth more in 5 years is just that, it's a promise. But a cash dividend clearing in your brokerage account, that is undeniable, tangible value. And Gordon argues that investors will absolutely pay a premium for a stock that offers that certainty.
Section 4. Breaking the tie. Real-world determinants.
So, we've seen the academic theories, the strict math, and the human psychology. But how do actual companies finally make this decision when the rubber meets the road? Well, when executives sit down to formulate a functional dividend strategy, they have to actively balance 5 concrete real-world factors. First, earnings. A company literally cannot pay what it hasn't made, so historical and projected profits set the absolute baseline. Second, liquidity. A firm might be massively profitable on paper, but if all that money is tied up in inventory or real estate, they just don't have the actual liquid cash on hand to write dividend checks. Third, taxation. If capital gains are taxed at a significantly lower rate than dividend income in a given country, a company's investors might practically beg management to retain the cash just to avoid a massive tax bill. Fourth, shareholder expectations. A utility company attracts retirees who depend on steady dividend income to pay for groceries, whereas a massive tech startup attracts growth investors who would be furious if the company paid a dividend instead of innovating. And finally, fifth, future financing needs. If a company knows it needs to build a massive new manufacturing plant next year, it is absolutely essential to retain capital right now to fund that expansion without taking on terrible debt.
Ultimately, dividend policy isn't just some abstract academic concept. It is an ongoing, high-stakes balancing act. Firms are constantly weighing the pure math of returns and costs against the psychological preferences of their investors, all while navigating the strict, unforgiving realities of earnings, liquidity, and taxation. It requires a really nuanced understanding of both macroeconomics and human behavior to get it exactly right.
As we wrap up this explainer, I want to leave you with a final, somewhat provocative thought. Think about your own hard-earned money. Which theory do you trust more with your investments? Are you siding with the Modigliani-Miller purists, believing that payouts don't really change a firm's underlying value, so it basically all washes out in the end? Or are you with the pragmatists, demanding that near-certain bird in the hand because the future is just way too unpredictable to trust? It's a fascinating question to ask yourself the next time you log in and look at your portfolio. Thank you so much for joining me to explore the strategic balance of dividend policy.